What broke this week that almost nobody covering this market actually caught? Silver fell hard in China. It fell hard in New York, too. But the one number that was supposed to confirm Chinese buyers were panicking right alongside everyone else barely moved at all. If you own silver, if you're thinking about buying some, or if you just want to understand what real physical demand looks like the moment a market comes under pressure, stay with me, because this matters more than the headline you probably already read about this week's sell-off. Before we go any further, I want to ask you something. When you picture a precious metals market in genuine panic, where do you picture that panic starting? Most people would say New York, or maybe London, some trading floor full of screens and futures contracts flashing red. Hold on to that assumption for a minute, because what's been happening in silver this week is going to test it directly. For a long time, the working assumption in the metals world has gone something like this. COMEX, the big New York futures exchange, is mostly a paper market. Contracts get bought, sold, and rolled forward constantly, and only a tiny sliver of them, commonly cited as under 1%, ever end with someone actually taking delivery of physical metal. Shanghai works differently. The Shanghai Gold Exchange is built around real physical delivery, so when a solar manufacturer, an electronics producer, or an investor buys silver there, a meaningful share of that trade ends with actual bars moving into an actual vault. Because Shanghai deals in the real thing, the assumption has generally been that it lags New York a little, cushioned by something traders call the premium, which is simply the extra amount, in dollar terms, that Chinese buyers pay for silver that gets delivered rather than just traded on paper. That assumption has held up reasonably well for a long time. This week, it got tested harder than usual. Here's the actual picture, and the framing matters more than any single number. Silver in the West has been trading in the high $50 range, down more than 20% over the past month alone, one of its roughest stretches in a long while, and that's after a year that took silver to an all-time high just above $121 an ounce back in late January. Gold has had it just as rough, arguably worse. It's been sitting in the low 4,000s, down more than 10% for the month, and on pace, by some measures, for its worst quarterly performance since 2013. Now here's the part that should have been the tell. If Chinese demand were genuinely cracking, if buyers in Shanghai were losing confidence the same way New York clearly was, the premium they pay over the Western price should have shrunk. That's what a real loss of confidence looks like in a two-tier market. The buyers willing to pay extra stop being willing to pay extra. Instead, even as prices fell hard on both sides of the Pacific, the Shanghai premium held. Depending on which daily fixing and which tracker you check, it's been running somewhere in the high single digits up to around 11%, essentially the same range it's occupied for weeks. But here's where it gets more interesting, because a number that refuses to move isn't really a story on its own. The story is why it's refusing to move. And that answer runs through a brand new Federal Reserve chairman, an inflation spike tied directly to a conflict that's been simmering on and off since February, a ceasefire that keeps nearly falling apart, and a supply deficit that's been quietly building for 6 years running. Let's take those one at a time, starting with the man currently doing more to move this market than anyone else. His name is Kevin Warsh, and if you haven't been following the Fed closely, here's what matters. Warsh is a former Fed governor, the youngest person ever to hold that job, and he helped steer the central bank through the 2008 financial crisis before leaving in 2011. This January, President Trump nominated him to become the 17th chair of the Federal Reserve, replacing Jerome Powell. The Senate confirmed him in a close, largely party-line vote in mid-May, with just one Democrat crossing over to support him, and he was sworn in on May 22nd. His first meeting running the Fed's rate-setting committee came on June 17th, and by most accounts, he used it to send a message. Fed policy statements have traditionally run long, often 300 words or more of carefully hedged language. Warsh's committee put out a statement of just 130 words. He also declined to submit his own personal projection to the Fed's so-called dot plot, the chart showing where each policymaker expects interest rates to land. Of the 18 other officials who did submit projections, 9 penciled in at least one rate hike before year-end, essentially an even split between those still expecting steady rates and those now leaning toward tightening. The committee's median projection moved up to imply roughly 1/4 point hike by the end of the year, a shift from where it sat back in March. He also used the moment to announce a handful of task forces aimed at reviewing how the Fed operates day to day, touching everything from how it communicates decisions to how it collects its own economic data. A signal that the shorter statement wasn't just a one-time stylistic choice, but the start of a broader overhaul. None of that means a hike is guaranteed. Committee projections are forecasts, not promises, and Warsh himself has been openly skeptical of the whole exercise, arguing publicly that locking in forecasts can trap policymakers into positions the data hasn't earned yet. But markets trade on probability, not certainty, and in the weeks since that meeting, the odds of a rate increase, as measured by futures markets that track the Fed, climbed noticeably. Several recent readings put the chance of at least one hike by September somewhere above 60%, and some estimates run higher still. That shift matters enormously for silver and gold, for a reason that's easy to forget when you're just staring at a price chart. Neither metal pays you anything to hold it. No dividend, no coupon, nothing. When the return on cash and short-term bonds rises, the opportunity cost of holding a metal that just sits there rises with it. So when a new Fed chair spends his first month in office sounding more hawkish than Wall Street expected, precious metals are often the first place that shows up. But interest rates alone don't explain why the mood has turned this sour this quickly. For that, you have to look at the inflation numbers Warsh actually inherited. The Fed's preferred inflation gauge, the Personal Consumption Expenditures Index, came in at 4.1% for May, the hottest reading since 2023. Core inflation, which strips out food and energy, ran at 3.4%, still nearly double the Fed's 2% target. The Consumer Price Index told a similar story, with May's headline number at 4.2% year over year. Here's the detail that actually matters, though, because it changes how you should think about this spike. A large piece of it isn't broad economy-wide pressure, it's energy specifically. Prices across the energy complex have climbed roughly 23.5% over the past year, and that surge traces almost entirely back to one place: the conflict between the United States and Iran, and specifically the fight over who controls traffic through the Strait of Hormuz. If you haven't followed that story closely, here's the short version. Fighting between the US and Iran escalated sharply at the end of February, and for weeks afterward, a waterway that normally carries somewhere around a fifth of the world's oil and liquefied natural gas was effectively closed to a huge share of shipping. Traffic has picked back up considerably since a memorandum of understanding was signed in mid-June, but picking back up isn't the same as resolved. Just this past weekend, the US and Iran traded strikes again, hitting targets as far away as Bahrain and Kuwait, before both sides agreed to stand down and return to the table. Technical talks between American and Iranian delegations, mediated by Qatar and Pakistan, are continuing in Doha this week, even as Iranian officials have publicly downplayed how much those meetings will actually accomplish. Whether that fragile de-escalation holds through the rest of this week is genuinely an open question, and it's one of a handful of things worth watching closely, which we'll come back to before we're done here. So here's the chain worth holding together all at once, because none of these pieces make full sense in isolation. Fighting near a critical oil choke point pushes energy prices higher. Higher energy prices push headline inflation higher. Higher inflation gives an already inflation-focused brand new Fed chair every reason to sound tough. And a tougher Fed is exactly the environment that makes a non-yielding asset like silver or gold harder to hold on to, at least in the short run. That's the monetary side of this story, and this week it's been the loudest voice in the room. But it isn't the only voice, and understanding why means switching from macroeconomics to something far more physical. So why does Shanghai specifically end up being the market where this kind of pressure shows up hardest, rather than spreading evenly across every exchange on Earth? The honest answer is structural, and it comes down to what these two exchanges actually are. COMEX is overwhelmingly a paper market. The vast majority of contracts that trade there get closed out or rolled forward in cash, and only a small fraction ever result in someone taking physical delivery. That's not a flaw. It's simply what a futures market is designed for: price discovery and hedging, not warehousing. The Shanghai Gold Exchange works differently. It's built around physical delivery, so when Chinese industrial buyers or investors purchase silver through the exchange's deferred delivery contracts, a meaningful share of that activity ends with real metal moving into a real vault. That difference means the Shanghai price tends to be more sensitive, not less, to how people who actually use silver for something are feeling in real time. When the macro backdrop turns uncertain, the way it has this week with a hawkish Fed, a hot inflation print, and a ceasefire that keeps threatening to unravel, industrial buyers are often among the first to pause. Not because they've stopped needing silver. Solar panel and electronics production schedules get planned months in advance and don't turn on a dime. It's more that nobody wants to lock in a purchase the day before a headline out of Doha could send the whole market moving again. That kind of hesitation can move a delivery-based market like Shanghai's faster than it moves a paper market, where speculative positioning often takes a session or two longer to fully reprice through futures rolls and margin calls. Which brings us back to the number we started with. Because once you understand what Shanghai actually is, that premium stops looking like a curiosity and starts looking like a real signal. Remember, if this were genuinely about Chinese confidence in silver breaking down, the premium is exactly the part of the price that should have moved first. It exists specifically because Chinese demand has been willing to pay more than the rest of the world for the same physical ounce. Instead, it barely budged. And once you look at what's happening underneath that number, it starts to make a lot more sense why. Before we get into what's underneath it, I want to ask one small thing of you, because it genuinely matters for how a channel like this works. Videos that try to slow down and explain the mechanism, instead of just chasing whatever number is trending, only get made because enough people stick around to watch them the whole way through. If you found this useful so far, hitting subscribe is the simplest way to tell me this kind of slower, deeper analysis is worth making more of. It costs you nothing, and it's genuinely the biggest factor in whether more of it gets made. So if this has been valuable, take 5 seconds and do that now, and then let's get into why that Shanghai premium has been so stubborn. There's a structural story underneath the silver market that doesn't care much what a Fed chair said on a Wednesday, and it's worth understanding because it's the backdrop against which all of this week's volatility is playing out. China's silver import licensing rules, tightened back in January, haven't been loosened. The tax structure on physical imports hasn't changed. The logistical friction that keeps traders from instantly arbitraging away the gap between Shanghai and Western prices is still there. None of the machinery that creates and sustains that premium has been dismantled. What changed this week is simply the global price level both markets are repricing against, not the underlying tightness of the Chinese physical market itself. And that tightness is real, and it's well documented. According to the Silver Institute's most recent World Silver Survey, produced with the research firm Metals Focus, the global silver market is on track for its sixth consecutive annual deficit in 2026, meaning the world is expected to consume roughly 46.3 million more ounces of silver than gets mined and recycled this year, up from a shortfall of about 40.3 million ounces in 2025. Add those annual shortfalls together going back to 2021, and the industry estimates that more than 760 million ounces have been pulled out of above-ground stockpiles just to keep pace with demand. That kind of structural drawdown doesn't reverse because interest rate odds shifted a few percentage points, and it doesn't pause because Shanghai had one rough trading session. Think about what's actually pulling that silver out of the ground and into circulation. Well over half of annual silver demand now comes from industrial use, not jewelry or coins. Solar panels alone consume a meaningful share of it, since silver remains the most efficient conductor available for the cells that turn sunlight into electricity. Electric vehicles use several times more silver per unit than traditional cars, thanks to all the additional wiring and electronics packed in. And more recently, the build-out of AI data centers has added another steady source of demand, since silver shows up throughout the high-performance electronics that keep those systems running. None of those buyers particularly care what the Federal Reserve does in September. They're purchasing planned around production schedules and government clean energy targets that move on a completely different calendar than interest rate decisions. Here's a similar story unfolding in gold, which tends to move the broader mood around silver even when the two metals diverge short term. The People's Bank of China has now been adding to its reserves for 18 straight months, according to the most recent available data, bringing its holdings to somewhere around 2,332 tons, close to 9% of its total reserves, with an 8-ton addition in April alone, its largest single-month purchase since late 2024. China's broader gold imports told a similar story in the first quarter of this year, coming in at roughly 317 tons, nearly triple the pace of the prior quarter, according to research from J.P. Morgan. Meanwhile, on the COMEX side, the portion of vault inventory actually available to satisfy delivery, what's called registered silver, was last measured earlier this year at a fraction of where it stood back in 2020, having fallen from roughly 346 million ounces down to around 88 million. When that available pool shrinks relative to the number of paper claims sitting on top of it, the cushion protecting the system from a genuine physical squeeze gets thinner. That doesn't guarantee a delivery problem is coming, but it does mean Shanghai's stubborn premium and New York's thinning buffer are, in a sense, two different ways of describing the same underlying condition. A market where the physical side has less slack than a single day's price action might suggest. Now, I want to be fair here, because I didn't put this video together to sell you one side of a two-sided story, and the honest picture has real risks attached to it that could still get worse before they get better. If Bank of America's newest forecast plays out, this environment gets tougher for silver, not easier. The bank reversed its own outlook within about a week and now expects the Fed to raise rates 3 separate times this year, in September, October, and December, taking the federal funds rate up to a range of 4.25 to 4.50%. That would be a genuinely difficult backdrop for any asset that pays no yield. Goldman Sachs has already acted on similar logic, cutting its year-end gold target from $5,400 down to $4,900 in the days after that June Fed meeting, and explicitly warning that an actual hike could drag that number down further, toward $4,400, if gold's usefulness as a hedge against future rate cuts keeps fading because those cuts simply aren't showing up. On the other side of the ledger, J.P. Morgan has held on to a considerably more bullish view, still projecting gold near $6,000 by the fourth quarter of this year, even after trimming its full-year average forecast down to account for softer near-term demand. Notably, J.P. Morgan's own economists don't even expect the Fed to hike at all this year. Their base case is actually for rates to hold steady, which tells you their bullish gold call rests less on the rate path and more on structural buying, from central banks and from investors, that they expect to keep showing up regardless of what the Fed does next. Deutsche Bank sits somewhere in between, penciling in 2 hikes rather than 3. Nobody on Wall Street is claiming certainty here, and that disagreement is itself worth noticing. One thing that's easy to overlook in moments like this is how often markets confuse price with value. They aren't the same thing. A falling price tells you where the last trade happened. It doesn't automatically tell you whether the underlying asset suddenly became less useful or less scarce. History is full of examples where commodities, equities, and even entire sectors traded well below what later proved to be their long-term value, simply because investors, for a period of time, cared more about liquidity than fundamentals. Silver has gone through this cycle repeatedly. During periods of aggressive monetary tightening, investors often sell what they can, not necessarily what they want to. That's an important distinction, because liquidation driven by changing financial conditions can look almost identical on a chart to liquidation driven by collapsing demand, even though the two have very different implications once the dust settles. The challenge, of course, is figuring out which type of selling you're actually looking at while it's happening, instead of months later when the answer becomes obvious. That's also why professional commodity traders spend so much time separating leading indicators from lagging ones. Price is the number everyone watches because it's visible every second of the trading day. But inventories, import volumes, refinery activity, exchange premiums, central bank purchases, and industrial consumption often tell the deeper story long before prices fully reflect it. Think of price as the headline and the physical market as the reporting underneath that headline. Sometimes they agree immediately, sometimes they diverge for weeks or even months before eventually converging again. The Shanghai premium is interesting precisely because it belongs in that second category. It's not simply another price quote scrolling across a screen. It's a window into whether buyers who actually intend to take delivery of silver are changing their behavior. And when that signal refuses to confirm the panic that's showing up elsewhere, it's usually worth paying attention before assuming the broader market has already told you the whole story. The World Gold Council's newest central bank survey, the largest of its kind on record with 76 institutions responding, found that 89% expect global central bank gold reserves to keep rising over the next year, and a record 45% said their own institution specifically plans to add more gold. Those are two different questions with two different answers, and it's worth keeping them separate. Most central banks expect the world to keep buying gold collectively, while a smaller, still record share expect to be buyers themselves. Then there's the gold-silver ratio, which is really just a way of asking how many ounces of silver it currently takes to buy 1 ounce of gold. That ratio sits close to 69-1 right now, noticeably above the long-run average many analysts cite, which is somewhere around 65-1. For context on how far this ratio can swing, it spiked to roughly 125-1 during the most extreme days of the COVID crash in March of 2020, then compressed all the way down to about 54.9-1 this past May, when a US-China tariff truce briefly reignited industrial demand expectations for silver specifically. That range tells you two things worth sitting with. First, this ratio can move a long way in a short amount of time once the industrial and monetary stories start pulling in the same direction. Second, where it sits today is closer to the rate hike fear end of its recent range than the industrial optimism end. Historically, stretched readings like today's have sometimes come before stretches where silver outperforms gold, once whatever's driving the fear starts to fade. That's a pattern though, not a promise, and nobody can tell you with any certainty whether or when it repeats this time. So where does that leave things right now, in the next few days specifically? There's a small handful of events worth watching closely, because any one of them could shift this picture meaningfully. Today, Fed Chair Kevin Warsh is making his first public appearance outside the United States since taking the job, sharing a stage in Sintra, Portugal, with the heads of the European Central Bank, the Bank of England, and the Bank of Canada at the ECB's annual policy forum. He isn't expected to announce anything about the Fed's next move. That's not really what these forums are for. But given how closely markets are already parsing his tone after that unusually terse policy statement, even a small shift in emphasis could move expectations for September. Thursday brings the June jobs report, released a day earlier than usual because of the July 4th holiday. Economists are currently looking for something in the neighborhood of 110,000 to 115,000 new jobs, with unemployment expected to hold near 4.3%. That might sound like a narrow range to care much about, but remember what happened with May's report. Economists were looking for something like 85,000, and the actual number came in at 172,000, more than double what was expected, and both gold and silver sold off sharply within hours of that release. A similarly large surprise on Thursday, in either direction, could do something similar. And then there's Doha, where technical talks between American and Iranian delegations continue this week under Qatari and Pakistani mediation, even as Iran's government has publicly played down how much those talks will actually accomplish. Whether that fragile de-escalation holds, wobbles, or breaks down again will keep shaping how much risk premium the whole market is pricing in for renewed conflict around the Strait of Hormuz. But if you only watch one number out of everything in this video, watch the Shanghai premium itself. As long as it keeps holding somewhere close to where it's been, even through more price weakness in the days ahead, the structural demand story underneath silver stays intact. If you start seeing that premium genuinely shrink, not just hold flat through one rough session, but actually compress down toward 5 or 6% over a sustained stretch, that would be a real signal that Chinese physical demand is finally cracking, and it would matter more than almost anything else happening in this market right now. Here's the thing worth carrying away from all of this. Silver, more than almost any other asset people own, runs on two clocks that don't always agree with each other. There's the monetary clock, Fed meetings, jobs reports, ceasefire headlines, and right now that clock is running loud, fast, and genuinely hawkish, more than capable of pushing prices lower still if the data keeps coming in hot. Then there's the physical clock, solar installations, electronics production, 6 straight years of a market that consumes more silver than it produces. And that clock does not particularly care what happened in Doha this week or what Kevin Warsh says in Sintra today. This week, the monetary clock won. It's been the loudest voice in the room. But the physical clock is still running underneath it, and a premium that has refused to close, even through a genuinely ugly month for prices, is some of the clearest evidence you'll find that it hasn't stopped. So here's what I'd actually ask you to sit with. If you were watching this market with real money on the line, which clock would you trust more right now? The one that moves in hours, or the one that's been running quietly and consistently for 6 years? There's no single right answer, and honestly, most people who do well in this market end up paying attention to both. But I genuinely like to know where you land. Drop a comment and tell me which side of that you're watching more closely right now. And if there's one number from this video that changed how you're thinking about it, tell me that too. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk in.